Let me begin the proceedings by welcoming Major Anil Kumar, who's a veteran, Army veteran, and he's a very successful entrepreneur and a businessman today. On behalf of the Peninsula Foundation, let me welcome, it gives us a great pleasure to welcome Anil Kumar today, Mr. Anil Kumar today.
Thank you, sir.
He's going to be talking to us about, investment, global investment, patterns and opportunities, which will be of great interest to, the industrialists, particularly in the context of, the defense and Make in India process that's now under, great push from the government. And I think it will be a great benefit to each one of them who will probably be listening to this, and to all of us as well. The Peninsula Foundation has, you would be aware, Sunod must have actually sort of given you an earlier indication. It's a new think tank in Chennai. We work on four important focus areas, which is governance, democracy and governance, science, technology and security, international affairs, and innovation and transformational paradigms. We focus towards enhancing the knowledge base in the region, and focus on younger generation, particularly towards capacity building. And of course, the main focus area is on policy research to actually work towards addressing certain issues in terms of policy recommendations and policy corrections. Without taking much more time, let me now invite our senior fellow, Dr. Sunod Jacob, to take on the proceedings further ahead. Sunod, all yours.
Thank you, Marshal. It gives me a great pleasure to introduce our speaker for today, for the evening, Major Anil Kumar. Major Anil, retired. Anil is a motivational speaker, leadership expert, fundraiser for alternative investment funds, and a highly decorated former military officer. Passionate about bringing out the best in people, Anil inspires and encourages leaders to build world-class organizations and realize their true potential. His mantra, stay curious and be happy, is reflected in his wide range of life experiences that he shares through simple stories. Anil works with Lyra Capital LLC, raising capital from institutional investors for alternative investment funds like hedge funds, private equity, and debt funds. Mr. Kumar started his corporate career in 2004 as Director of Sales and Marketing with Vega Assets Management, a $12 billion hedge fund platform with offices in Madrid, New York, and London. He, along with his teams, have raised more than $1.5 billion US dollars since 2004 for various alternative investment funds. Anil started his professional journey as an infantry officer serving in the Indian Army for over 10 years. He is a recipient of the Gallantry Award Shaurya Chakra, awarded by the President of India for exceptional bravery in anti-terrorist operations. Mr. Kumar is an alumni of London Business School, the Indian School of Business, where he majored in leadership and change management and marketing. He is an undergraduate of the prestigious National Defense Academy. Anil is a dedicated father of 2 young girls. He is married to a senior Indian diplomat, and the family has lived among different cultures in India, Spain, Argentina, Singapore, Switzerland, Oman, and Italy. So with this wide range of exposure, we have Anil with us. And let me just add, it's great reconnecting with Anil after 18 years, and I look forward to hear from you. Over to you, Anil.
Thank you, Sunod. Thank you for those kind words of introduction. And before the audience starts thinking that I'm going to speak on a motivational lecture today, it's not the case. As Air Marshal sir had already pointed out, it'll be on my core work, which is the alternative investments. And thank you so much for giving me this opportunity to speak on this topic, which is alternative investments in India. It's a very exciting topic, exciting for some, and I think it's intriguing for a number of people because there's been a lot of press coverage, and there's a lot of movies that you see about alternative investments, which portray the alternative investment space as somebody like, there's some movies that show us in a very bad light. But anyway, it's such a broad range of word. Alternative investments, when we talk about alternative investments, is pretty broad. So what I'm going to do today is I'm going to focus on what is alternative investment space in India and what the regulators have done, how it has been shaped up. And it's a very nascent, it's a very new industry that has come up not long ago. So alternative investments, though, have been widely utilized by the investment community in the advanced economies since the middle of last century, but their growth story is still very new in India. As I was mentioning, in fact, before 2012, India did not have any regulation that defined or regulated the alternative investment funds. SEBI had opened up the fund management industry back in 1996. There were something called as venture capital funds regulations of 1996. They were made to encourage funding of early stage companies in India. However, over the years, what happened was VC funds was being used by several other funds like private equity funds, real estate funds, etc., etc. So that made it difficult to target concessions and incentives that are specific to VC funds without enabling other funds to avail such incentives or concessions. So moreover, the incentive restrictions that were in place for VC funds were not really suitable for the other funds, like the private equity or venture capital or hedge funds, etc. So on the one hand, you had these VC funds that required incentives and concessions and were comfortable with restrictions attached to that. And on the other side, there were private equity funds that did not require these incentives or concessions, but required investment flexibility. So, alternatives, you need a lot of flexibility to invest in companies, to trade into the markets and stuff. So since the registration of the VC funds was not mandatory under the VC funds regulations, all players in the alternative funds industry were not registered with SEBI. And it left a big regulatory gap, actually. And that regulatory gap was the reason why investors are not looking at the Indian alternative space and not putting in money there. So SEBI came up with the framework back in August 2011. Then they took the public opinion on that. And after extensive deliberations between public and the regulators, they came up with the regulations that were issued in May 2012. So now all the funds that are established in India, which is the private pooled investment vehicles, raising funds from either Indian or foreign investors, excluding the mutual fund and the collective investment schemes that are not regulated by SEBI, are part of this regulation. I would, it's a little complex subject because alternatives is a huge thing, and people mix it up with banking, but banks and pension funds, etc., these are not regulated by SEBI. These are regulated by other regulators. So these don't really cover under these preview of these regulations. So just to make it easy and make the discussions flow a little bit easier, I'm just going to share a little small presentation that I have made on the funds. Let me just share that with you. I think, yeah. So here we go. Sunod, is it visible on the screen?
Yes.
Yeah. So
this is screen.
Yeah. So this is primarily the definition of alternative investment funds as per SEBI. I've highlighted the features that alternative investment funds have. So firstly, they are privately pooled investment vehicles, and they collect funds from not you and me, but from sophisticated investors. And India has given this option of either Indian or foreign investors coming in. And it's a defined investment policy for the benefit of investors. And AIFs, they don't really include some funds, which are, some exemptions are family trust, ESOP trust, employee welfare trust, holding companies, and securitization trust. Moving ahead. A big question everybody asks, why alternatives? Why do we need alternative investment funds when we can go to the stock market, invest in the funds that are available, or why do we invest into something which gives us the access to the markets, but in a very different way? So I was mentioning to you, AIF, the investment funds came into existence post World War II in the US, and it has grown into a 10 trillion plus industry across the world. And investors find it appealing. What's the appeal of the alternatives is it's a necessary source of investment returns, specifically nowadays when it is a low yield, low growth, and high volatility environment. The volatility of the markets post the COVID has increased so much. And even though there's a rebound, there's a recovery which is taking place at the moment, but it will still take years for the volatility to actually go down. So in this scenario, you don't want to risk your money into the traditional asset class, which is equity and bonds or the mutual funds. So another point is alternatives have a low correlation with the traditional asset class, and that's how they can combat, my military wording comes again, you combat volatility, and they can provide you with diversified income to combat the low yield environment, which is currently on. And then investors can get a illiquidity premium while investing through the alternatives. So investors get a wide range of options and also greater flexibility with alternatives. But as is true with every walk of life, with bigger returns, you want to get bigger returns, you got to take higher risk. So high risk, high returns. And who better than the military guys who can understand that if you take more risk, yes, there are returns, but you can always get shot. So having worked in the hedge fund industry, I would like to, for now, over the last 15 years, I would like to share one anecdote from my journey about this particular point, which is there right in front of you, about bigger returns but higher risk. I get reminded of an incident in March 2008 when my hedge fund group, which was managing a decent chunk of money at that time, went into some problems in February 2008, wherein some of the positions that we had taken went against us. So one of the aggressive funds, which has more aggressive nature of trading the markets, had taken on some extra risk, and we were losing money. So on 1st of March, the fund was recapitalized with $100 million of our own money, which was the partners' money. Our own means, everybody, including the employees' money, went into that. And the reason was our managers who were managing the capital felt that this is the right opportunity and the risk reward ratio has in fact become better, and the market will come reverse to the mean and we'll be able to make handsome profits. So lo and behold, on the 5th of March, we were down 25% from 1st of March. So the 100 million of the new money that was gone into the fund was now only at $75 million. So we had to take a call. And if you would recall, in the financial markets, Bear Stearns incident was very big in March 2008. And this was happening just a week before Bear Stearns had went bust. And the markets were so dislocated that nobody was able to give us a price for the securities that our funds held. So using all the goodwill, using all the experience that we had, and we took a big haircut, we closed the fund because we had breached all the risk limits. And as per the regulations, we were supposed to cut the risk when we breach our risk limits. We went much beyond because the market were dislocated so much. And actually, the sad part is the fund could get back some money for the investors, but the firm couldn't stay on. So each one of us lost our jobs on one particular day. And if you may call it on probably one set of investments that we thought were great investments and they would give us great returns. But not to get deterred by this experience that I just shared with you. The last point, as we were looking at on your slide, is if the fund investors are ready to take one or two of such unpleasant experiences, but the overall portfolio is well diversified, then you can always reduce the volatility into your in your overall portfolio and make handsome returns over the period of time on a long-term basis. So with a well thought out, diversified based on investment objectives, you can actually reduce volatility in the portfolio that you have. And as I was mentioning to you earlier, the myths about alternative investment funds, negative portrayal in the movies, negative narrative built by the press over the years, all this is slowly waning out. And more people are looking at alternative investment funds, and our funds are going mainstream now. Besides that, if you have there's a risk factor portfolio analysis and allocation of very proper allocation, they are bringing the alternatives to the core of the client investments philosophy now. In terms of, even I would say insurance companies and pension funds, they are also investing a lot in the alternative funds because they've been able to do the liability matching and the long-term income streams. They can match with the investments, and they can find better transparency now, which has been given by the alternative investment funds. And plus, alternative investment funds are now also going to, I would say, going to a proper institutional quality platform, and that's when they give a proper, a good, robust infrastructure for investors to invest with alternative investment funds. Going forward, so what does alternative investment funds do? They address a range of investment needs. I've listed them out, depending on what investors are looking for, whether the investors are looking for income or growth or inflation protection, or they're looking for diversification in their portfolio, or if they're looking at reducing volatility in the portfolio. So there are different asset classes like hedge funds, illiquid credit, private equity, infrastructure, and real estate. So these are the kind of needs that can be met by the alternatives for the investors. As I was mentioning, in India, it's very nascent. So what SEBI has done is they have categorized the alternative investment funds into three categories. Category 1, Category 2, and Category 3, which are listed in front of you. So Cat A, mostly the strategies that invest in startups or early stage ventures or social ventures or SMEs or infrastructure. Primarily those sectors where government considers them socially or economically desirable. Category 2 are the funds like private equity or private debt funds, where there's no specific incentives given by the government, no concession given by the government. And there's a difference between them, between Category 2 and Category 3. Category 2, they cannot take leverage, and they cannot borrow money other than meeting their day-to-day operational requirements. And the Category 3 are the most speculative ones, funds which employ complex or diverse trading strategies, and they may employ leverage, including through the investments or listed or unlisted derivatives. Hedge funds, funds that trade with a smaller margin, they come under this. And even the funds that are trading into Bitcoins, funds that are trading into wine, art, and different sets, funds that are trading into asset-backed securities, aircraft leasing companies, all these guys would come into Category 3. The spectrum is huge and it's very wide. Just in a nutshell, what I actually told you is just listed in front of you. These are the kind of funds which would come into Category A, Category 2, and Category 3 funds. moving ahead, so there's some of the key facts that I have placed in front of you for the alternative investment fund industry in India. So as I was mentioning, AIFs can be placed only through private offering. So you won't really see an ad into newspapers about a hedge fund or a private equity fund or a debt fund. You can't have a public offering for that. In terms of the number of investors, maximum number of investors in any AIF scheme cannot exceed more than 1,000 investors, and maximum number of angel investors who cannot exceed more than 49 investors. In terms of taxation, Cat A and Cat 2 are tax pass-through vehicles. The TDS will be deducted, and then there is a 10% withholding which is done initially while making distributions, and what would actually be withheld for offshore investors, that is the foreign investors, will be determined based on the double taxation avoidance agreement which they have with India. And in terms of the foreign investments, SEBI has opened up all the alternative investment funds for foreign investments, and this depends upon the discretion of the finance ministry and the fiscal policy that we have. It would change the range of alternative investment could alter. And very important is the manager or the sponsor's continuing interest. At least 2.5% of the fund or a minimum of Indian rupees 50 million, whichever is less, the manager has to put in his own skin in the game so that there is a comfort for other investors to know that 2.5% of the fund minimum is with the manager. So this is exciting. This figure actually shows the fund raised in Indian rupees in billions, and the category 1 is green, blue is category 2, and red is category 3. So there's a increase, and you see the sudden increase in the asset under management or the funds raised into this category, and that makes it interesting. And that's why I was saying, it may be intriguing for many, but it's a very exciting space to be in, especially at this time in India. And if you look at the chart in 2012, when the regulations came in, I think I have the figure somewhere with me. I can read out that, yeah, so it's 5.3 billion rupees was raised during the year 2013. And the fundraise shot to 1,342 billion rupees in 2019. And 2020 and 21, despite all the COVID restrictions, the run rate is in fact accelerated with the people bringing in money, a lot of private equity money coming into tech space, whether it is edutech or fintech or SaaS and all these places. So if you look at the chart in front of you, I would say that we had 3 distinct phases in the last decade. Between 2011 to 2015, we were coming off from the very low base, and number of fund managers entered, and the industry started growing, and number of people became very active participants in India. In percentage terms, the growth was very high, but in terms of the notional, it was not that great. The initial phase was followed by 2015, 2016, to a certain extent about 2017, wherein the investors became very focused on the high quality investments. And then last few years again has seen the renewed growth phase, because what happened was many of the funds that initially invested in 11, 12, they exited the investment that they made with multi-baggers. So there was a multiples of 8, multiples of 9, which if somebody invested $1 million, got out $9 million out of that. And the investments were like huge. They were $10 million investor getting about $80, $90 million out. And there were multi-baggers also. There were people who made 50, 60 times the money in 5, 6, 7 years. So as I was saying, there's been a lot of startup activities in terms of fintech, SaaS, also in e-commerce. And then COVID-related restrictions gave a boost to online activities. I would have ideally come and spoken to you in person, but we are using Zoom every single day for all our lectures and stuff. And there's and investors are also, the alternative investments is also coming into the e-commerce companies, health tech companies, food tech, educational tech, and all this thing. I think in terms of the alternative investment space is concerned, looking ahead, what we see is the ecosystem in India. It is robust and rapidly growing. And we shall see an increased interest in the global investment community that is looking to invest in India with bright idea generators that are entrepreneurs. So you would see a lot of money coming into the VC funds, and then when they mature, they'll come to the private equity funds. Several funds are increasing their allocations because it's a VUCA nature of the dynamically changing world that we live in, and it'll keep pushing fund managers and investors towards active management. And India being a high growth story, they would definitely be increasing their allocations to India. As I was saying, several regulatory programs, it would help investors to have more comfort level when they're investing in alternative investment funds. I would like to mention here, India has set up its first IFSC, which is the Financial Services Center, International Financial Services Center in Gift City, Gujarat International FinTech City. So I'm okay on that. So to promote IFSC, government has already announced, a lot of tax incentives and stuff like that, and regulatory entities that are set up in IFSC would have a little bit of tax breaks and stuff. So these would help bring in more alternative investments into India. And I think a lot has been spoken about our flagship programs like Startup India, Digital India, Atmanirbhar Bharat. But besides that, the Alternative Investment Policy Advisory Committee, they continue to improve the environment for alternative investments to come to India. And investors are definitely looking at post-COVID growth potential of India. And I feel AIFs are set to grow exponentially and might be the most favored product for investments in the coming years. There's a massive inflow of foreign capital, which is increasingly investing in alternatives. Central banks are printing money. Last week or this weekend, there was $1.9 trillion of more capital came into US with their. And besides that, most of these central banks are buying up government debt and making it, money is becoming cheaper, and there's a lot of liquidity in the market, and opportunities are less, and more money is chasing returns. And where do you get returns in this environment where there is a low yield, there is a high volatility, and if you invest in any of the government debt, you make zero. If you put money in the bank, in Switzerland, you have to pay 75 basis point, almost 1%, to keep money with the Swiss bank. So a lot of money coming out, and India being the growth engine, one of the growth engines in the new century, which is in Asia, I think a lot of more money would come. And they may not invest in the stock market, but they would like to invest in a way where they can reduce the volatility of their returns, and it's a long-term investment that they could do. And the most important point is young talent is moving out of the management companies, asset management companies, and setting up their own funds, which would also encourage investors to look at them. It's again something to do with the freedom of taking bold decisions, being entrepreneurial, and of course, for the managers, it's a higher payoffs. So we can see this trend continuing, and it would help in bringing more depth and in terms of the talent pool which is available to manage AIFs in India. So I think we are set for a big growth in this particular region in the alternative investment space in India. I think, Sunod, as a military man, I should be closing it now exactly at dot what you told me, that you got 25 minutes to speak. So I have looked ahead and I'm going to end it here. And thank you for inviting me and letting me speak. There's a lot to speak, but I just wanted to keep it concise and give you a bird's eye view, a snapshot of what alternative investment funds are all about. And I'm sure your researchers would get interested and start looking at this, which is unfolding. And that's why I put up this slide for everyone to get excited about what's happening here. And it's not a small sum of money which is coming into the sector. So I'll end it here. Over to you, Sunod.
Thank you, Anil. Thank you. That was very interesting and actually intriguing too. I'm sure our researchers will have a lot of questions to ask. And in fact, at the earlier stage, when you had confirmed, we had already received a long list of questions, and which has been shared. So we'll go through those questions, and keeping in mind the time available, it's possible that we may not be able to exhaust all the questions. This is a message to our researchers. So we'll start with the first question. The first question is, you pretty much explained what the current state of alternate investment market in India is. But the second part to that question is, how does it compare with the global alternate investment market? Thank you.
Globally, the AUM has increased at a very rapid clip, like India it is. So I would say in 2013, we were managing about $6.5 trillion under the bracket of alternatives. And it crossed about $10 trillion last year. And it is on track to exceed about 14 trillion by 2023. So in absolute term, if you look at Indian market is still small, but if you look at the trajectory, the money has been pouring in at a fast clip as investors are taking a notice of the excellent long-term opportunities that India is providing. And they want to make some diversification they want to move away from the developed markets, which are more static, and its information flow is very quick, and it's very difficult for the alternative investment guys to make outsized returns. So they want to come to India, and you would notice that the fastest growing part of the asset management in the country, in India also, is an alternative part. So as compared to the global counterparts, if you look at it, we are still small, but we are growing. And in terms, I just want to take a specific thing. The one thing which has taken quite a bit is the tech VC. So we're getting a lot of money in the technology firms. So venture capital has come, probably I would say, is more comparable to the global trends. Rest are yet to develop.
A follow-up question to that, Anil, is that from a decadal growth point of view, there has been growth, and you have shown from a decadal growth point of view. But however, do you feel that this growth rate can be sustained beyond this decade? That is one aspect. Especially given the low levels of market capitalization currently, is there a potential for this market to be tapped into? And what does the future of India's alternate investment industry look like? Thank you.
Okay. So for me, I'm very confident. There is a growing interest in the alternative investments. It will not only be sustained, but it will grow even further. I think what would happen is the Indian alternative investment industry would get more integrated with the global players. You would have more flow of information, more flow of capital with the global players going forward. And the big guys are already here. The BlackRocks and of the world are already here. a number of private equity groups, which are the marquee one, TPG, and as I was mentioning. So these guys are already here, and the integration is going to increase, and there'll be a growing interest, which will be sustained. For your second part of the question, which was about the market capitalization. So, as the markets gain more depth and breadth, so there'll be more space for strategies like hedge funds to play out. India currently sits at about 8th among the world's top stock markets, and it crossed 2.5 trillion market capitalization mark for the first time in December, end of December 2020. So when the markets grow, there'll be a depth, and there'll be more opportunities to come. And when there is more opportunity to come, as I was mentioning, there's so much of capital chasing such less opportunity set that we will be there to get capital coming into India through hedge funds. The future, the industry is still new, still fragmented, but we can see it is becoming more segmented. The firms that are looking for sustainable growth will develop more sophisticated market strategies. It will allow them to acquire necessary skill, necessary talent, and capabilities that are needed to grow. There'll be more diverse strategies that leverage unique skill sets that are there. So, you'll get into even the hedge funds, you'll get into the segmentation, better, more granular trading strategies that will come up. And operationally, what we would see is two things are going to happen. One is more talent will come in, and the other thing is the asset management companies, when they get integrated with the global players, they will become more homogeneous as a group to create strength in their operations and processes. So when all that happen, it will be a win-win for India. In short, I would say it's a multi-decade opportunity. Depending on, of course, we can't really leave out, depending on taxation, depending on investment talent which is available, respective parts of the industry, category A, category 2, category 3 will develop. So it's difficult to predict at this stage about taxation I was talking about, because the direct tax reforms are yet to set in. And I think on taxation, once all types of investors and all investments are treated in the same bracket, it will take off in a big way. So there's a lot of money on the sidelines looking at India once we sort out a few of the glitches that are there in terms of taxation and regulatory framework. Okay.
The next question is a more specific question. Given Reliance's geo platforms that they had recently raised over 1 lakh crores, including several investments by tech giants and blue chip investors in the US, do you think global interest in Indian alternative investment is increasing? And what are the factors making India a preferred market? Thank you.
Geo was a great story. There's a lot of money that came in, and surely the interest in India story is increasing. And these kind of marquee deals do help the India story being globally advertised. So coming to Geo, Geo did extremely well because India has a large consumer base and it did a very smart penetration. And Geo actually had a great impact on data pricing and data consumption and data speed. It had impact on the newer opportunities for contents and videos. So it's a great story to tell. And as Prime Minister Modi says, the data is the new oil. So there are a lot of opportunities which will come up. And it just so happens that COVID came in 2020 and the Geo story played out a few years before that. And people were much more comfortable using the data. And we had the availability of data so that we could switch from working in the offices to work from home so quickly. So India has proven that we are able to switch from one portion to another depending on this new thing. So I'm digressing, from there. India has, I think, one of the top 5 startup ecosystems in the world, which has continued to grow rapidly. If I look at my data, yeah. So from 2012 to 2019, the number of startups have grown by 17% each year, while the funded startups have shown a compounded annual growth of 19% during the same period. And among the funded startups in India, typically 25% of them or more go to raise subsequent rounds of the capital. And that is the alternative investment that's coming to you. Besides that, I was mentioning about Startup India, Digital India. There are schemes like Atal Innovation Scheme. Then you have a Small Industries Development Bank of India. All these have helped create a favorable environment for startups and venture capital and private equity growth in India. Moreover, I think India has taken prudent and timely regulatory policy decisions, and we've also seen in doing the improvement in ease of doing business over the last 5 years. I think we were around 140 in 2014, and we grew to about 63rd in 2019. I haven't really checked the 2020 details on that. So yeah, India is becoming a preferred market because of all these reasons that I just discussed with you.
Thank you, Anil. The next question, before I move on to the next question, I would invite our audience to feel free to raise your questions in the chat box, which we shall take up in due course. Yes, the next question, Anil, is on the National Investment and Infrastructure Fund Limited, which was established by the government to help drive domestic infrastructure investment in the country. Given the current push towards long-term infrastructure investment, one second, let me just paraphrase this question. Will funds such as the NIIFL help drive domestic infrastructure investment in the country? Thank you.
The answer in short is yes, because not just NIIFL, but all the players that come in this segment, because this is one sector which we need. We need infrastructure, be it roads, be it ports, be it airports, energy, whatever you name it. India is in real need. We've not been able to cater for it. It's not so long ago where electricity used to go and we used to be on a standby. But now we can be discussing the whole discussion without the fear that electricity would go. I'm just praying, it shouldn't go. But yeah, there's a clear need for big money to finance the infrastructure sector in the country. We need large and continuous capital infusion, which is across both old and new infrastructure projects. So coming to NIIFL, I think Indian government has about 49% in that, and the rest is held by the marquee foreign and domestic investors like Abu Dhabi Investment Authority, Temasek, and HDFC Group. So it naturally helps for such partners beside the government of India, and if they make money down the line, surely it will be a good story and more players will follow in this extremely important sector. And but given the long gestation periods of these projects, they need long-term patient money. I would say you have to have patience to go into the infrastructure projects, which will start giving back money in 15, 20 years. So a quasi government or quasi sovereign wealth fund like NIIFL can bridge that gap, and they can take a very long-term view. And especially in the current challenging circumstances, post-COVID plus, there is a bad loan problem at many banks, and I think we shouldn't forget IL and FS mess. It was a big mess that was there. So many of these traditional infrastructure financiers are tight-fisted, and we do need alternative funds to step in. So yes, but the marker is always the same, with any government identity. if NIIFS is independent to make independent investment decisions without pressures from the government of India, then it would be able to generate value in its investments as well as for itself and for its investors, which is Abu Dhabi Investment Authority, Temasek, all these people who are there. And that will be a good story for other players to come in, because I don't think they can fill in all our requirements. We need lots of money to come into infrastructure. Yeah.
Thank you, Anil. I'm sure, yeah, being in Delhi, you can confidently say that you wouldn't be worried about the power. And so do we, based in Chennai, since we are power surplus. I wouldn't say the same in case of Gurgaon, because it provides a different experience. Anyway, moving on to the next question about the legal framework. This, the alternate investment sector is gradually seen to be moving into the mainstream. Do you see the law has caught up, the regulatory mechanism has caught up to the pace at which this alternate investment has gradually moved into mainstream? Or do you think the law is yet to be refined in that sense?
It's always work in progress, but I think there's been a conscious effort from SEBI to put in place regulations that safeguard investors, and that creates a sound alternative investment fund asset class in India. So it keeps asking public, the market participants, for comments on new initiatives. I think recently the Alternative Policy Advisory Committee, AIPAC, decided to introduce templates for PPM. That's the first thing that investors look for, the PPM, the memorandums for investments. And they also, wanted to do the mandatory performance benchmarking for AIFs with the provisions for additional customized performance reporting. So they came up with these kind of things. So they keep looking at granular requirements that investors have, so that investors feel confident that our regulatory regime is good. I think you would have been reading in the news, Government of India is also going to come up with some decision on Bitcoin soon. And you must have seen a number of articles, both positive and negative. Some are demonizing the Bitcoins and some are rooting for the Bitcoins. So overall, it's I would say it's work in progress, but investor community, including the financial foreign institutional investors, have shown a big vote of confidence in the Indian regulatory regime, and they've been coming in with sacks of dollars to come and put in with the private equity deals in India.
Thank you, Anil. Earlier, you had highlighted how the Indian startup ecosystem has developed enormously. And you had highlighted that that's a system that has great investment potential. Are the investments in this category matching the demand for capital by these startup companies? And what more needs to be done to increase investment in this category of companies? Thank you.
Yeah, I mean, I touched upon this earlier. We have such a large pool of reservoir of very talented people who are very innovative, have a entrepreneurial spirit, are ready to work tirelessly to start companies, generate employment, and obviously make handsome profit for investors who are willing to take risk, back them up with finance, and be a part of that startup's journey right in the beginning as a venture capital guy or angel investors. We do have a lot of dry powder on the sides. The amount of fund that I was showing you, the amount of money that has been raised, especially in the middle bucket, which is huge, not all is used. It's basically the commitments that are raised on that particular year. So even money from 2019 is there with the investment companies. They have the dry powder. And investors have been looking for right opportunities and investing wherever they can, but they have to do their own proper due diligence to see. So in terms of what we could do more, probably at multiple levels. I'll come back to very basics. Encourage students to bring their bright ideas to bear and start early. Incubation hubs in the universities, we have to encourage them. And there are things, I was reading an article recently. There are these forums which bring together those entrepreneurs, the budding entrepreneurs who have got a good, bright idea, and they bring them in one place. Initially, they used to have meetings, but now they're doing it even virtually. And they just match the founders of the startups with the investors, both angel investors as the venture capital. And I was surprised. There's a small town guy who's got extra cash, who's invested with one of these startups, and he's made a decent amount of returns with that startup. So all these kind of forums, the ecosystem has to be built up for us to, what we can do. I think overall, if the investment talent is there, we align the tax structures across investor type and investment type is done, it would help increase investments in all kind of categories. And also I think by, it's more specific to the industry. If you allow single stock pool structures, that would also help the investments to come in more. I think I need to go faster on the next question.
Already discussed the.
Yeah. Go ahead.
No, the next question you addressed it partially because you discussed the COVID and its impact. So I'll move to the question after that. According to the RBI regulations, scheduled commercial banks, excluding regional, rural, and urban cooperative banks, are only allowed to invest in Category 1 and Category 2 alternate investment funds. Mm-hmm. Do you think scheduled commercial banks should be allowed to invest in Category 3 AIFs with rigid guidelines, of course? What would be the impact? Thank you. That's a loaded question.
I worked my whole life in my professional life in Category 3. It's highly speculative. And in my humble opinion, scheduled commercial banks don't have the bandwidth to actively manage investments in these funds. If you look at post-2008, a number of international banks that had big investment banking units or the benches or desks got out to focus back on core banking. And then post Dodd-Frank rules, bank had to realign themselves, boost their tier 1 capital, and also rethink about the leverage. And the Basel III came in. So a lot of regulatory work has been done to curtail the greed of some of these players that go through the cracks of the risk management systems, and they're not able to make it. So coming to, when you said AIFs with rigid guidelines. So Europe does allow retail investors to invest in Category 3 types of funds, but retail banks can only offer these onshore, something called as UCITS funds, so UCITS structured funds to their investors. So UCITS have a number of restrictions in terms of how much leverage can a hedge fund take, what are the types of underlying instruments, what are the type of underlying investment that they can make and trade, etc., etc. And even though a UCITS fund manager may mirror a hedge fund, but returns cannot be the same. So there are a lot of restrictions that are in place. So as far as Indian banks are concerned, they have their problems today. Let's face the facts. Once they are sorted out, they will play a crucial role, but those selectively. I think probably Cat 1 and Cat 2 will be more suitable. But if India does allow scheduled commercial banks to invest in Category 3 funds, as you mentioned, it has to be with, from my opinion, humble opinion, it has to be with very, very rigid guidelines. And if that guidelines are in play, then it may take out the sheen out of the funds, curtail their flexibility.
Thank you, Anil. The next question is related to the union budgets, direct and indirect measures such as the extension of tax holidays, higher capex, etc. Do you think these would benefit the alternate investment funds industry as the sector as such?
Industry, I don't think there's much impact directly to the industry. I won't say that, but indirectly, yes. If the markets are doing well and companies are doing well, there'll be opportunities for the industry. But as for the AIF industry is concerned, I don't think there's any direct impact for us.
Okay, thank you. The last question is that very general question, but an important one. Alternative investment fund is a growing industry. What would be your advice to investors who are new to this sector? Thank you.
Especially category 3, it's a very risky investment, and at times, even category 1 and 2, they are highly illiquid. So even if you have an option to invest category 3 funds that might provide better liquidity, the underlying strategies or instruments that they trade could be something that investors may not be familiar with. The issue is, please do your due diligence. I repeat, due diligence properly before investing, as there are just too many variables. There are just too many variables to look into. This is a full-time job, and mature investors, be it family offices, fund of funds, pension funds, insurance foundations, they have dedicated teams. They have dedicated teams separately for investments and dedicated teams for operational due diligence and then due diligence. So for investments, they also have dedicated teams even broken down to look at different fund strategies. In a hedge fund space, they would look at, one team would look at global macro, the other team would look at equity long short or commodities, and there would be another team looking at private equity and real estate investment. So the canvas is huge, and you may get into problems if you go in thinking that, yes, this is the most attractive and the lucrative space, and you don't do your diligence. So that's why, as I was mentioning to you, it's fragmented, but it has to become segmented. So it would mean that I think my advice is please
do the due diligence. Thank you. Thank you, Anil. Now we'll open the floor for questions from the audience. Thank you.
Yeah.
Okay, let me start. Anil, I just have one important question. Is you mentioned about the rising, story of startups in India, and but the investors, when they put in the support the startups, don't they also look at the success rate? And if I remember correctly, the last year's analysis of success rate of startup systems in India, somewhere I remember to have read as 1 in 10. That amounts to about 10%. Will that be a major factor on how they decide to support startup systems? If you relate the best success story for the many decades now in startup ecosystem is in Israel, where the success rates are more than 40% actually. So how do we compare there?
Well, sir, it depends on, if you look at Silicon Valley, which is, my brother had worked there for very many years, and he was with 2 startups, and both startups failed, unfortunately. And then he came back to India. He started 3 startups. So first failed, the second failed, and the third worked. So he was the 5th time lucky. So normally investors are looking at a bigger percentage of startups to succeed. But having said that, they understand that out of the 10, even if one makes outsized returns, they would be able to come through. So that's the reason why diversification is the key. And most of the family offices, or most of the people, or even the venture capital funds, they would invest in a wide range of investments, maybe do 20 investments, and if 2 or 3 succeed, they would have made their money. So I think we can't compare Israel to India in that sense, but other comparable markets, if it is Europe or US, I think we aren't really badly off in that sense.
But shouldn't we learn something from Israel, because they're also financially probably the most savvy people in the world? And how do they combine the two? And how do they bring out that kind of a success rate? Given the emphasis that we are now placing on Make in India, which logically should be all about getting technology successes in the country. So shouldn't we be actually studying Israel far more closely and learning lessons from there?
Oh, definitely, sir. I've been in Israel and I spent 2 weeks there, and it's just amazing to see the society. It's just amazing to see the hub, the incubation hubs that they have, both in especially technology and stuff. The kind of investments that they have done in terms of the human capital development is huge. So I guess that's where the answer lies, is why they succeed in doing what they're doing is because firstly there is a lot of integration. Number of these individuals who are coming back to Israel would have been in New York or in Silicon Valley or other places, and they would have worked, earned their spurs there or done their education there. They come back, so there is a clear flow of information between New York and Tel Aviv and New York or Silicon Valley, and that's the reason why you find that there is more in terms of finance chasing these opportunities with all these young entrepreneurs who come back to Israel and start their incubation. So yes, there's a lot to learn. I guess we would. Having seen a lot of different worlds in terms of the startups ecosystem is concerned, I think we still follow that Indian philosophy of spread the seeds around, and even if 10 seeds don't make it and one grows, it'll be a good tree. So rather they do a focused testing, and it shows up even in the agriculture part of theirs. If you look at how they make cherries and how they grow bananas, it was amazing to see banana growing there under the shade.
Yes.
So usage of land. So I guess it's more culturalizing.
That's true.
And any further questions in the chat box? If not, we've gone past our scheduled time. Now I would invite my colleague to deliver the vote of thanks. Thank you.
Good evening all. It gives me immense pleasure to deliver the vote of thanks for this wonderful event. We thank Mr. Anil Kumar for accepting our invitation despite his busy schedule, and for truly providing us valuable insights into the potential scopes, but also explaining the basics of the climate around alternate investments in India. It was really interesting, and we young researchers came up with questions to ask. So thank you so much for answering all of them with patience and in detail. Thanks to Air Marshal and Matheswaran, founder and chairman of the Peninsula Foundation, for chairing the event, and Dr. Sunod Jacob, our senior fellow, for moderating this event. I'm sure all of us have benefited immensely from this. Once again, thank you, Mr. Anil Kumar. We hope to interact with you again in the future.
Thank you. Thank you for having me over, and thank you for all the wonderful questions that you posed, made me think. Thank you.
Thank you.
Thank you. And we hope to see more of you with our foundation.
Yes.
And interact with us even further beyond this one lecture.
Thank you, Sunod.
Thank
you,
Anil.
sir.
Thank you, Anil. And I hope to be in touch with you. And like Sunod said, we need to work much more together. Thank you. Thank you.
Thank you, sir. Thank you for having me. Thank you. Have a good evening, sir.
And all the best.